Well, hello, this is Jim Musgrave at Research Financial Strategies, and this is the first in a series of weekly market updates that are meant to keep you informed with the stock and bond markets. So today I want to start talking a little bit about the bond markets year to date, and I'm going to bring up the yield on the 10-year Treasury. And the reason why this is important is that we've had a huge spike in the yields in the 10-year Treasury. Here we are in May, and in June, and you can see this huge spike right here. And you can see that this spike has continued up to the present here in mid-late September. Why is this important? It's important for a number of reasons. One is that, remember, if you buy a house and get a mortgage, the mortgage rate, interest rate that you pay is directly correlated to the 10-year Treasury. So we've seen a increase in the 30-year mortgage from about 3.5% to 4.5% in a fairly short period of time, and so that has done a little bit to kind of slow down the refi. But again, we're still pretty strong in regarding real estate, at this point. Now, the second reason why this is important is because remember, yields and bond prices go in the opposite directions. So I'm going to get up the aggregate bond index, and this is the benchmark that we use for our bond portfolio. And you can see right here that the overall bond asset class has dropped. So here we are in May, and you can see this big column of O's into June, and you can see that bonds have continued to just get crushed over the summer. And so what do you do about this? Well, one thing that you have to do is that you have to manage your bond portfolio just like you would a stock portfolio. So what you need to be doing is selling your long duration bond funds and replacing them with short duration funds, floating rate funds. You can do bond convertibles as well as cash. And so you definitely need to adjust your bond portfolio if you haven't done so. You can certainly see that bonds as an asset class has taken a huge hit since May of this year. Now, kind of moving on to the stock market. Okay, I'm going to get up the S&P 500, which is ticker SPX, and I'll just kind of fill you in a little bit with what's been going on this year. And I want to kind of zoom in on the S&P 500 to kind of give you more of an in-depth look at what's going on. So here we are down here in January. We had a wonderful first quarter. Again, here's a sequester pullback, but the market surged to the sequester, didn't really care. And you can see that the market just spiked through May, which is quite frankly, a bit surprising because we normally have a pullback before then, but this year the pullback started in May instead of April. Well, you can see right here that the market peaked at 1685, and we had a pullback to around 1565 right here, which is about 9.2%. Why did this happen? Well, for a number of reasons. The main reason is that Ben Bernanke testified in front of Congress, and they're talking about tapering their bond buying program right now. Again, just if you're not familiar with that, the Fed is buying $85 billion worth of bonds per month, and any thought of the Fed tapering or not buying as many bonds or raising interest rates, the stock market does not like that, and that uncertainty caused a drop in the market. And so that's one reason. That's one of the main reasons that we saw volatility in June. Now, we had a recovery, and we had a nice surge here in July, and the market peaked at about 1709 just very, very briefly in the very first day or two in August. Okay, but again, we saw another pullback right here. Why is that pullback? Again, more uncertainty with the Fed, but also that's when we were seriously considering bombing Syria. Fortunately, that has not happened, and that seems like we're not going to go to war right now, so those are two positive things. You can also see this big column of X's right here, and that is a result of a couple things. A, what I just mentioned, not going to war with Syria and bombing them, but also B, is that earlier this week the Fed met and they decided to everyone's surprise, not to start tapering their bond buying process. And so it was interesting. On Wednesday, the Fed made the announcement at 2 p.m. Eastern Time, and literally within 2 to 3 minutes, we saw the Dow jump from negative 40, 50 up to plus 140 within a matter of 2 to 3 minutes. So, currently we're still in a column of X's right here. Now, one could argue that as a result of the Fed not lowering interest rates, that we are in a more risky environment. Okay, so remember, the reason why the Fed continues its easy money is because they feel that the economy is weaker than initially estimated, and this is not good. So again, the economy and the unemployment rate is still just kind of slowly improves, but it's really not doing much. And so remember that the Fed will continue its current policies until unemployment drops to roughly 6.5%, and it may take a year or two for that to happen. So easy money is certainly in the foreseeable future, but again, it's the uncertainty is one thing that the markets do not like. The second thing that is the more immediate threat to a pullback is the debt ceiling debate, and that's heating up, right this minute. And if I go back, kind of zoom out on this chart just a little bit, and we go back here to 2011, this is the last big debt ceiling debate that happened, and we had roughly a 20% pullback in 2011 just because of that. So politicians on both sides of the fence don't want this to happen, but again, you never know until they come up with a last-second deal. So we are riding this wave of positive trend in the market. We started buying positions again in the last week or two, and so we are currently making money, and the market is still in positive trend. But I tell you what, we are poised to exit quickly if we see the market starting to deteriorate as a result of the debt ceiling. So that's my report for the week. If you have any questions about your own accounts, or you want me to review your accounts that I don't manage, I'm happy to do so. Give me a call, send me an email. I'll be happy to talk with you. And again, thanks for taking time to watch this market review. And I hope you got a lot out of it, and I hope you can attend the next one. Take care.